All right, so as we film this video, we're in early May and a lot has happened in the markets and the world, to say the least. And if you're watching this video, you may be wondering, how do we make sense of all of this? Bob, how would you make sense of all of this?
So let me answer that question from a wealth management,
Mhm.
investment, financial planning perspective,
Okay,
not a political perspective.
Sure.
Try not to play too much politics because it's just that's a black box.
Mhm.
But from a wealth management perspective, first of all, we've had historic volatility created by, we think, because of all the tariff activity that our new administration has put into place. And to me, I would just sort of ignore that.
Mhm.
I think the volatility that has occurred is just sort of normal market volatility that we have once a year or once every other year. And for long-term investors, they shouldn't pay any attention to it. Now, for somebody who needs to spend that money in the short term, different story. They probably should, on this rebound in the markets that we've had, they probably should take a couple of chips off the table, so to speak, and think about reallocating their account in that manner.
Can you explain what you mean by take a couple chips off the table?
Sure, that's a poker term. I don't play poker. I'm the worst poker player in the world. But it is, what we're suggesting there is take profits, take the money off the table. In other words, reallocate your portfolio so that the money that is allocated to the stock market is long-term in nature,
Mhm.
3, 5 years or longer, would be appropriate. And the money that you're going to need in the short term for living expenses or to buy a house or for projects, whatever it might be, that should be in bonds, probably short-term bonds or cash investments.
And as advisors, that's one of the biggest things that we can do on behalf of our clients. It's something we're watching on a day-to-day basis,
Right.
Especially in times of major volatility or,
Right.
or frequent volatility.
Right. So in our portfolio construction with each of our clients, every year, we are discussing with them their vision, their goals, their objectives, and our mission is to align their investments in their portfolio with our client's vision.
Mhm.
I often use the example, if you don't need the money, if you're never going to spend the money, then it's probably a sort of a perpetual account that can be invested probably 100% in stocks.
Yeah.
You can get the highest rate of return that way. On the other hand, if we're meeting and Chris, you say to me, hey, I'm going to cash out and buy an island
Yeah.
like this year,
Mhm.
then we should talk sooner and reallocate your account accordingly because you're going to withdraw your money in the near term. So those are the two extremes.
Yeah, and getting a little off topic, but it's a very relevant thing. It's for some people, depending on how many accounts they have and the type of account, some accounts can be the investment objective can be adjusted for that longer term goal, and while other accounts are adjusted for more of that shorter term spending needs goal.
Do
So
that all the time.
another thing to absolutely bring up with your advisor, that's why we have these meetings throughout the calendar year, not just one meeting in a calendar year, so that we can continue to touch base and check in on those investment objectives for all of your accounts, not just the portfolio as a whole. So,
Right.
all right, so let's get into some specifics here. Talk to me about interest rates, where not just you, but sort of the market tells us that interest rates could be trending over the next several months and throughout the year.
Right. So the forecast, the market participants are forecasting that interest rates are going to be lowered a couple of times this year, later in the year, and maybe once next year. Maybe it'll be 3 times this year, maybe 2 next year, who knows? But the forecast is that rates will be declining somewhat. When we talk about rates, we're talking about short-term rates. Those are the rates that the Federal Reserve control.
Mhm.
If you think about interest rates, their objective, their mandate with interest rates is to control inflation and to control unemployment.
Mhm.
Their target inflation rate is 2%. We're running higher than that right now, around 3%. Their target unemployment rate is down around 4%. So when they've met those objectives, then they're going to stabilize interest rates at those levels. So that's the objective. They're working towards achieving that. They're reacting to all the other things that are happening in the world and in the markets and with corporate America, and they'll attempt to navigate that towards those 2 objectives.
Keeping the folks who might be watching this in mind, as an investor, why do interest rates matter so much? Why does CNBC, for example, cover interest rates so closely? Every news outlet. Why are they covered so closely?
First of all, short-term interest rates affect the money market interest rate that you're earning. Our money market now is paying about 4%, but if they lower interest rates by 0.5%, then your money market interest rate is going to go down by about 0.5%. Those interest rates that the Federal Reserve can control also affect your borrowing costs. If you're borrowing money for a car or a house, whatever it might be, then that will have an effect as well. The savers will not be rewarded because their interest rate on their bonds and short-term investments are going to go down. But investors, people who are investing, will benefit from lower interest rates. There's the trade-off that the Federal Reserve that's attempting to balance.
Can you explain why investors would be benefiting from lower interest rates?
So if you're borrowing money to grow your business, you're paying less interest.
All right, so let's move on to tech stocks, AI and tech. What's going on there?
Boy, is that interesting. We are harnessing internally at Hapanowicz, we're harnessing AI to help us with our daily tasks and chores. And here in our compliance things, we keep copious records of everything with our clients so that nothing slips through the cracks, so that everything gets done right for our clients. And AI is helping us.
Yes.
So I think what you're going to see is over time is that there's sort of going to be a flattening. There's been a lot of AI related things that have been released in the last year or two, and there's going to be a flattening of these items, and then again a takeoff. There's a tremendous amount of money that's being invested in building out AI tools. For example, call center tools, and they are remarkable tools. So what I think is going to happen is that it's going to take a while for these investments to actually make a product. It might be months or a year or two, and then you're going to see the next wave of things that we can hardly even imagine what they're going to be in helping us achieve better, more efficient results. We are all in on technology and AI. And what I mean by all in, we have a commitment to those stocks and the appropriate amount in client portfolios. And because of that, we think that the benefit to the client is going to be good returns.
Even though it's been around for a while, I think relatively it's still considered to be such a new thing. Does that mean that this sector of the stock market can also come with more volatility then?
Sure it does. I mean, look at the opportunity right now. If we look at the S&P 500 this year at its low point intraday about a month ago, it was down over 20% for the year. It's rebounded. It's only down 4% for the year now. Our client portfolios are slightly up for the year due to our allocations. But if you look at the sector that hasn't recovered yet fully, it's technology and AI stocks. So the next question you're going to ask is, what are we doing about that? Well, we rebalanced into that. We bought technology, we bought large cap growth stocks last couple of weeks in client portfolios to take advantage of these lower prices and hopefully ride those up over the next couple of years.
And I mean, that's what you just mentioned there is a great concrete example for our clients who are watching, or folks who are not clients who might be wondering, okay, what does an advisor even do for me, right? That's a great example of the type of active management we provide. A phrase you always you use a lot, that I've heard you use a lot, is managing risk, allocating risk appropriately. And that's going to be different on a day-to-day basis, on a client-to-client basis. But also another phrase you like to use is, we let the markets tell us what to do.
Sure.
So
the markets are going down. We're looking at it as an opportunity to buy. If the markets have gone up severely like they have the last couple of years, it's been great. It's severe up move is great. So we've been trimming stocks and reallocating the bonds. So there's the opportunity. There's always opportunity in the markets, and we want to manage the things that we can control. I can't tell you if the market's going to go up or down today or tomorrow, but I can rebalance your account. I can do tax loss harvesting. I can do reallocations in your account and rebalances and tax loss harvesting.
Absolutely. All right. So what's going on geopolitically?
So we've got a couple of wars going on. There's always something going on. And again, with these things, I tend not to, I mean, we all look at the headlines, we see it on TV, we read about it in the newspapers and online on our computers and iPhones. But I think for the most part, it's noise. When it comes to the results in your portfolio, it's just noise. And at the end of the day, what drives stock prices higher? What drives the returns in bonds are corporate earnings. So if corporate earnings and strong balance sheets drive stock prices, and that, by the way, is investing 101. as corporate earnings go, stock prices generally follow over the long term. So, and that's what's happening. We focus right now on balance sheets, corporate balance sheets like Apple and Microsoft and all these big companies have never been stronger than they are today.
Mhm.
There's records amount of cash on hand. It's a little bit cloudy right now because of the tariff environment, et cetera. But by and large, what we hang our hat on is that corporate America, the managers of these companies are paid,
Mhm.
and they are paid to find ways to navigate these things. And it's always been a bad bet to bet against America, and always been a great bet to bet with America
Yeah.
and corporate America and their results in the equity markets.
As long as I've been working here, which has been a long time now, we've always, because of that, we've always had a bias towards US stocks in our clients' portfolios, you know, because of that reason. All right, so what's going on in the green energy, clean energy industry sector? How is that affecting things?
I think that's an industry that is continuing to evolve. We all want to have a better environment. Unfortunately, it's going to take everybody to cooperate, and it can't just be the United States of America. China is a huge violator of the green movement, right?
Yeah.
It's a very dirty country, as there are many dirty countries around the world. We can do our part, but our part is just, it's barely moving the needle.
Yeah.
I think it's going to take whatever leadership by whoever to continue to move that forward. But in the meantime, there are some of us who are all in on it, and whatever it might be, electric cars, harnessing other, solar powered things, et cetera, windmills, whatever it might be.
Yeah.
That those are continuing to evolve. I think if you look at even the big oil companies, they all have a component. They're doing carbon capture, whatever it might
Right.
be. It's all happening, and I think that'll continue to evolve. And I think that should be a portion of somebody's portfolio too.
Is that sector of the stock market, is that typically more volatile, or maybe does it depend on the specific company?
Depends on the specific company. It's such a small asset class now that the amount of volatility compared to everything else is
Sure,
insignificant.
sure, okay. In general, what was the temperature taken on first quarter earnings?
Really good first quarter earnings. And as we discussed earlier, what we're seeing from a lot of companies like Ford is they're removing their guidance going forward. They just don't know how the tariffs are going to affect them.
Yeah.
So they've removed their guidance. And I think there's a lot of companies doing that. And I think there's a lot of companies that are able to use tariffs to sort of hit the reset button.
Mhm.
It's like a free pass. It's like
Sure.
a Monopoly, you get out of jail free card.
Yeah,
Yeah, it's sort of the same way. They can use the tariffs to sort of hit the reset button and perhaps reset expectations.
Mhm.
And that's okay. I think at the end of the day, it's always been a good thing to bet on the side of corporate America if you
Sure.
want appreciation in your portfolio.
yeah, and in the short term, because investor sentiment is something that can greatly affect the short-term activity of the stock markets.
Right.
And another,
Markets are emotional in the
yes,
short term.
yes, and also another phrase that I hear you say every so often is the markets are forward-looking, you know? So I say that because when these companies do, to use your phrase, remove their guidance, how does that affect consumer sentiment or investor sentiment, at least in the short term?
Yeah, I mean, it affects some of them. There are some active managers who want to reallocate their portfolios. If you don't know, if Ford can't tell you what their earnings are going to be going forward or give you a good projection, then you might not add more money to Ford stock.
Right.
Or you might choose to sell some of your Ford stock and maybe buy Mercedes-Benz overseas, where they do have guidance.
Yeah,
It does cause some reallocations to portfolios. And again, I think in the short term, if you have a broadly diversified portfolio with some international, which is up this year in
Mhm.
client portfolios, then you're doing the right thing.
exactly. I mean, I think one of the underlying things that I keep coming back to as we're having this conversation is just the importance of proper diversification.
Mhm.
Because truly, it is impossible to know every single year or every single quarter or every single month exactly who the winners will be and who the losers will be. You know, it's impossible to know that every single time and get that right every single time. And that's where diversification comes in, and an active and disciplined rebalance strategy as well.
Yes.
So, all right, and let's talk about commodities. What's going on with commodities right now?
Yeah, so slowdown in commodities, they have been good in previous years. What I mean by good is they were leaders in portfolio returns, helping to achieve portfolio returns, and this year they're laggards. So I think it's the normal cycle of things as as the economy has slowed down a little bit,
Mhm.
it's not grinding to a halt, but it has slowed down a little bit. It was virtually impossible for the economy to expand like it had over the last few years continually. It just can't go at that pace. It's
Sure.
so large. So it's inevitable that it slows down a little bit because of that. The demand for commodities like oil or copper, or whatever it might be, is slowed off somewhat. So commodities are slow somewhat. So it's, there are diversification tool in portfolios.
Mhm.
The exception would be gold. Gold has rallied significantly this year as the fear of tariffs and banking fears. So gold has rallied significantly.
Mhm.
That probably is about over.
Okay, all right. Just the overall theme that, and there's a couple other things I want to ask you, but the overall theme I'm gathering from you is that any hiccups we're seeing right now seem to be short-term or transient.
Yeah.
And I'm gathering from you that you're still bullish and confident long-term and where the markets are gonna go.
I would
Who
look,
knows how this year exactly is going to turn out, but
we live in the greatest country in the world. And it's all driven because of this sort of capitalistic system that we have. And capitalism is evolving. There's no question it'll be different tomorrow than it is today. It's different from what it was yesterday. It'll continue to evolve. But at the end of the day, where else would you want to be?
sure.
Yes, we have our warts here in this country, but we are, the phrase I've heard used in the past, we're the cleanest dirty shirt in the closet. Where else would you rather be?
Absolutely. What's your take on tariffs for the rest of this calendar year?
My personal opinion is it's going to go away in a few months.
Okay.
I think it'll all be resolved.
Yeah, the Trump administration has made it clear that tariffs are not their only strategy.
Who knows what they're doing? I mean, he hasn't broadcast it. But my take on it is he's using them as a negotiating tool to get people to come to the table. So who knows how that is resolved? But I think that it's impossible for those to be sustained over the long term. Common sense tells you that. So I would, that's why I'm suggesting that I think that they go away over a period of time.
Sure. Okay. Talk to me about, you mentioned this very briefly when we first started this conversation, the volatility we've experienced so far, at least from a numerical standpoint, is actually considered normal when you look at, long-term averages, historical averages.
Yeah.
Talk to us about
Yeah.
what in a given year, what can a client expect?
Yeah. So the last couple of years, we didn't have any corrections. So
Yeah.
typically you have a 10% or more market correction, like we just had. Usually that happens on average about once a year.
Mhm.
And then you have 2 or 3 or 4, 5% corrections in the typical year. We just haven't had those over the last couple of years.
Right.
So now we're having a correction and it's not as comfortable. We'd all like to earn 20% like we did last year and the year before, but that's just not sustainable. So the market corrections, I actually like them because it gives me an opportunity to go into a client's account and buy something a little bit cheaper than it was a couple of weeks ago and ride that up over time.
Right.
So we want to take advantage of volatility. Again, going back, my theme is I want to manage the things that I can control. I can't control the day-to-day movements of the market, but I can rebalance accounts, I can reallocate, I can do tax loss harvesting. And so I am managing the things that I can control in client accounts.
I think it's a really great message to round out on. Is there anything else that you want to bring up or say regarding, just a market update and what's going on?
No.
Okay.
I think the final thought is that volatility is an opportunity.
Yes.
It should be harnessed as a volatility. It shouldn't be looked at as fearful.
Mhm.
It should be looked at as an opportunity to take advantage and make more money.
Absolutely.
Yeah.
Absolutely.
So,
All right. Well, thank you
yeah,
for
fun.
sitting down with me. Thank you everyone for tuning in, whether you're watching or just listening. Make sure to subscribe to our YouTube channel to get updates on the latest video content that we release. And if you're a client of Hapanowicz and any of this conversation piqued your interest, reach out to your advisor to discuss it further. If you're not a client, still reach out to us. We're happy to talk with you. And we will see you guys in the next video. Thanks.